Welcome. You're viewing the video version of the Pirls Stock Market Commentary featuring the proprietary bull-bear point and figure market breadth summary chart for May 1st, 2016. Market breadth. With this past week's market decline, our bull-bear point and figure ratio at 1.60 fell from 2.05 last week, still within bullish territory. The total count of securities in bullish or bearish patterns decreased 2% to 3,174. The count of bearish stocks increased 15%, while the count of stocks in bullish patterns decreased 11%. The Pirls P&F Market Breadth Summary Chart shows us a market now 8 weeks in bullish territory. Paid subscribers have access to the Open Office Calc data from which the chart is generated. You may become a paid subscriber by visiting s2pmarketsignal.com, clicking Membership, clicking Register, and following the prompts. To receive the weekly email version of the Pirls Stock Market Commentary free of charge, simply enter your email address in the space provided. The well-known market breadth indicator, the Nasdaq McClellan Summation Index, rose 4 points for the 10th advance in 11 weeks. At a positive 515.89 points, it continues above all 5 tops within the last 3 years and continues above all 6 bottoms below minus 100 in the last 3 years. Volume analysis. In this week's volume analysis, the Nasdaq Composite Index ended in distribution mode with average daily volume higher than the prior week. In the last 2 weeks, the Nasdaq had 0 accumulation days and 6 distribution days. Accumulation days are counted when the index closes up on higher volume than the prior market day, while distribution days occur when the index closes down on volume higher than the prior market day. Last week also, the Nasdaq ended in distribution mode on lower average daily volume. Momentum, now at a minus 199.04, the CCI 20 daily fell from a positive 16.47 last week, is now within the plus or minus 50 range for a valid zero line reject long entry signal, and has 5 consecutive days below zero for an almost certain Woody's trend change early next week. In Woody's CCI trading system, 6 consecutive bars above or below zero are required for a change of trend. The weekly CCI 20 of the Nasdaq Composite Index began a Woody's uptrend last week, while the daily CCI 20 began a Woody's uptrend 9 weeks ago. Now, with 6 consecutive weeks above zero, the CCI 20 weekly is in a Woody's uptrend. It fell last week to positive 34.51 from positive 68.02 and is now inside the plus or minus 50 range for a valid zero line reject long entry signal if the market rises early next week. Industry rotation the last 2 weeks. All of the top 5 industries are positive, and all of the bottom 5 are negative. Summary: banking and oil on top, tech moving out of the bottom. Bullish, computer hardware disk drives and comp tech have left the bottom 5. REITs has left the bottom 5. Bearish, gold and silver has re-entered the top 5. Oil and oil services continue in the top 5. KBW Bank and brokers have left the top 5. Focus this week from www.dollarcollapse.com. Consensus forming. China heading back into financial crisis. By John Rubino. The following are some key points. China's historic post-2009 debt binge flew largely under the radar, fooling most observers into thinking the global economy was recovering rather than just releveraging. Now, Beijing is back at it, borrowing over $1 trillion in this year's first quarter, buying up commodities and creating the illusion of global growth. But this time the scam hasn't gone unnoticed. Reporters, editors, and money managers seem, at last, to be catching on. Doug Noland, meanwhile, goes to the heart of the problem in last night's Credit Bubble Bulletin. From a recent Financial Times article, the Chinese market for pledge-style repos, short-term bond-backed loans, is currently bigger than the stock of outstanding debt. So basically, in this popular market for interbank borrowings, borrowing banks have pledged bond positions larger than the entire market as collateral for their perceived safe short-term borrowing needs. China has an historic credit problem. It as well suffers from an unfolding money fiasco of epic proportions. My analytical framework attempts to differentiate the two, as each comes with its own set of related issues. A credit bubble is a self-reinforcing but inevitably unsustainable expansion of debt. Money, the contemporary variety, is a financial claim perceived as a safe and liquid store of nominal value. Importantly, systemic risk expands exponentially when risky borrowings are financed by an expansion of money-like instruments, financial claims. This typically occurs late, quote, terminal phase, end quote, in the credit bubble cycle. Based on supply-demand fundamentals, oil and iron ore remain in massive gluts. So when China's stockpiling ends, as it mathematically must, these markets will lose a lot of their exuberance. The question then becomes, how many speculators will default on their loans, and what kind of banking trouble will ensue? That's unknowable. But it's safe to assume, given the numbers involved, that the rest of the world will find it distressing. So think of today's relative calm as the eye of yet another storm, and what's coming as a return to the hyper-leveraged new normal. Thank you for tuning in for this week's Santu Pirls Stock Market Commentary, featuring the proprietary Bull-Bear Point and Figure Market Breadth Summary Chart, compiled by Donald Pearl, www.s2pmarketsignal.com. Hoping you are enjoying a peaceful and pleasant weekend, that you are looking forward to a productive and prosperous week coming up, and wishing you true success.